China's economy losing further momentum.
Okay, they are out, and not good. All right.
China slowing down, of course, affects Asia, affects the world.
Our country's going to hell.
This was supposed to be the year that China's economy came roaring back. What we've had instead are signs that this economy is struggling.
Holy smokes, China's deflationary crash could spell not just recession and depression for China, but also potentially recession for the world and America. Janet Yellen, our Treasury Secretary, is calling this a big risk. Donald Trump is worried about the United States dollar collapsing. And presidential candidates like Vivek Ramswamy suggest that China is being pushed closer to nuclear war with America. We have a lot to cover, and in this video, I'm going to talk about what's most at risk, where the opportunity could be, and what to think about everything that's going on.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
First, what's going on? Well, let's catch you up on that because there is a lot going on. To get started, consumer prices are down 30 basis points. That is not that big of a number, right? But what matters is the sign. It's a negative. It is the first negative read in 2.5 years, 28 months to be specific. And that's a big deal for China. Food deflation especially pushed us towards deflation in the last inflation report from China, which you should absolutely be taking with a grain of salt because the numbers are probably worse than they actually appear in the Chinese documents. But what's notable is that pork purchases and pork prices were down 26%. That might not seem like a big deal to those of us in America, but in China, it's worth noting that China is often the world's top pork producer, and pork is a big deal in the Chinese diet. So to see pork prices down 26% implies something that might be more than just temporary inflation. Of course, Chinese data suggests that, hey, well, core and services are still moving fine at 0.8%, so maybe it's too early to tell that China has with certainty fallen into deflation. In fact, it's leading some publications to go as far as calling the deflation that's happening in China transitory. Now, I did contort the headline a bit. It's actually a Financial Times headline that suggests that Chinese deflation is likely to prove temporary, but let's just say I have a suspicion it's going to end up being a lot larger and a lot longer lasting than anybody is expecting, mostly because of the real systemic issues in China's economy, many of those which we're going to talk about right now. But before we hit some of the banking crises and real estate crises that are now flaring up even worse, it's worth looking beyond just the inflationary numbers and understanding that production is at a negative 4.4% read. Exports are down 14.5%. Imports are down 12.7%. Retail sales in China are also much weaker than expected at 2.5% versus the larger numbers we've had in previous months and the 4% we were expecting. On top of this, you've got a massive debt problem. When you combine household, corporate, and government debt, you're sitting at total debt in China at 281% of their gross domestic product. This is not to be confused with just dividing government debt by GDP. That is, of course, a smaller number. This is adding everything together. And the reason we're doing that is because it's everything. Corporations, households, local governments, the big government, the CCP, all of them have too much debt. Unfortunately, when you have more debt, you end up being able to invest substantially less money when you'd actually like to the most. You'd like to invest when prices are low. But if you have too much debt, your payments are too high, the local governments can't invest in local infrastructure, and you actually end up exacerbating the problem rather than taking advantage of lower prices. That's the problem with bubbles. Everybody invests the money they have as things are going up in a way, as in a bubble, and then as soon as prices come down, they don't have money to actually invest when prices are low. Before we keep going, let's get the sponsor for the video out of the way. It's me. I have a bunch of different things that I think are amazing and you're going to love. Courses on building your wealth with an expiring coupon code tonight. We've got financial advice as well. That's where we do a portfolio review and analyze a wealth plan for you or some of the fundamentals that you're investing in. We can analyze all of that for you. Check that out at stackhack.com or go to meetkevin.com for those courses on building your wealth where you learn all of the principles of going from zero to millionaire to making money in the stock market, making more money at your job as an employee or as an entrepreneur. All of the tips and tricks that I've learned in these courses outlined easily for you to build your wealth. Take a look at all of these, link down below. If you have questions, email us at staff@meetkevin.com. Thanks so much. So those are some of the underlying problems in China, but now we're starting to get 2021 problems back yet again, leading some like JP Morgan to write the following: Chinese housing set for double dip crash. Our property analysts are revising down their full year forecasts. Wait a minute, what happened here? So what's worth noting is that Chinese property values plummeted in 2022, as much as 40%, especially as many of the ghost cities in China ended up vacant and the companies ended up bankrupt. As many as 40% of Chinese housing developers have ended up missing payments or going bankrupt. That is a massive number of companies. But things seemed better in 2023, since in 2023, we were comparing to that hole in 2022. That is, prices fell down in 22 and then kind of started rebounding in 2023. And so you look back, you're like, oh, look, prices are up 10% year over year. That's great after being down 30 to 40%. Okay, fine, some recovery. But wait a minute, now things are trending down again. And one of the reasons things are trending down is because the Chinese consumer has given up. We had a surge of spending in January of 23 as COVID lockdowns were finally released or ended. We finally had our Chinese New Year celebrations, and there was hope that China would become so productive this year that to some extent, not only would it rise global GDP, but if anything, it would actually potentially risk the chance of inflation rising globally, which is, of course, not something we would hope, but we would be able to grow and have growth to prevent a recession, which is ultimately what everyone in the world wants to avoid. A recession that leads to layoffs, joblessness, and more bankruptcies, because recessions are painful. Don't get me wrong, prices going up are painful as well. Some inflation is preferred, though, over a recession. That is why we have an inflation target at 2% and not 0, because we'd rather have a little bit of inflation than have a recession. Now, of course, we definitely need to have less inflation than what we've had, especially since inflation is cumulative after all. Prices have gone up substantially. But what's now happening in China? Well, remember this. China's real estate economy is about 30% the size of China's entire economy. That's about 1/3. So 1/3 of every dollar in China's economy, real estate. In the United States, it's about half that, only about $1 in $6. And unfortunately, we're looking at defaults. Consider what's happening with Country Garden. Country Garden survived the first wave of crisis in 2021, but now it's missed coupon payments and it's negotiating extension plans with those who have invested in Country Garden debt. This is not great because it could be the signal of the start of that double dip housing crash in China. What's worse is we thought Evergrande was bad. Evergrande, by the way, just filed Chapter 15 bankruptcy in America. That is for its US-related debts. It's already been a bankrupt company as it failed 2 years ago. So it's kind of like old news. We've seen it coming, but they did just file Chapter 15 just yesterday in the United States. But what's worth noting is that Country Garden was building as many as 4 times the amount of properties and homes that Evergrande was. That doesn't necessarily make them bigger, but amount-wise, Country Garden is a massive developer in China. And now you're having serious concerns with a potential double-dip housing crash, which more housing pain leads to less consumer wealth. We know this because Robert Shiller, who's a famous economist, famous for, of course, not only his research, but also the Case-Shiller Index, as well as other predictions, Robert Shiller has made it clear that it's not so much stock wealth that leads people to spend more or less. The normal person, or the average person, spends more or less based on the value of the home that they own. The same is true in America as in China. Now, in fairness, in China, 90% of real estate is actually owned by the CCP, but that's of land. Buildings are sold to individuals. And when you have let's say you have no ownership of land, and your building is now losing value in a housing market crash, to where you're looking, going, well, don't own the land, and the part that I own is losing so much value, it tends to lead to some inward lookingness. In other words, people spending less money. But not only are people spending less money because of a potential housing crash, they're spending less money because they have less money to spend. Compare China's consumer stimulus to what Americans received. Americans were locked down for like 3 to 6 months, okay, in some lame states up to a year. In China, Chinese were locked down for up to 3 years. What do we have in America? An average of $6,000 of stimulus per person. China, on average, $500. So in America, we got 12 times the stimulus being locked down 1/3 as long. And now other companies are starting to burn their customers in China as well. Consider, for example, the company Zhongzhi Enterprise Group. This is generally deemed to be a shadow bank, where you deposit money at this shadow bank. It's an investment company. They're a private manager of about 137 billion US dollars. I've converted the currency. And this company has halted payments to thousands of customers on some of their higher yield products, where they were promising yields about twice as much as what local banks were offering. And usually with higher yield comes a risk. But let's just say what we don't need in China now is more bankruptcy, restructuring, and collapse. Yet that's exactly what we're getting. In fact, behind the scenes, this company has already hired KPMG to likely start their restructuring process. They're also likely to dump assets in the way of basically liquidating so they can finally make their Ponzi payouts. This is a problem because then it lowers asset prices. More stocks falling, more real estate values falling. And unfortunately, the more stocks fall in China, the more desirable they get for foreign investors to potentially buy the dip on Chinese stocks rather than American stocks. It's all connected. So if something gets really, really cheap in one area, people flock to that rather than potentially American stocks, which means potentially lower American stock valuations as well. But things are so bad in China that now you've got the police calling customers of this company, this shadow bank, warning them not to protest. At the same time, the police is setting up aluminum fencing, not chicken wire, like seriously strong aluminum fencing around this company to prevent it from being attacked by the people who are frustrated that their promised payouts aren't coming. But then again, this is communism for you. It's literally like the thought police. They're calling you up just because you are thinking about protesting, telling you not to, and that you'll be arrested if you go protest. Because ultimately, with too much protest comes a loss of government power. And that's exactly what the CCP, the Communist Party, is afraid of. Now, we'll see. This company, the shadow bank, has filed statements on Friday that they've missed payments and that they're working with their customers, especially next week, on coming up with some kind of resolution for making these payments again. But a lot of folks are saying, look, lower stock market, housing market falling again, Country Garden going under, the shadow bank starting to not be able to make payments, and consumers not spending anymore. This is the perfect setup for a double dip crash in China, and unfortunately, it is going to have massive implications throughout the world. This is, at least for now, why foreign investors have dumped a lot of stocks so far in China. Now, and know that can be confusing because I said, hey, if Chinese stocks get cheap enough, other people start buying in China instead of America. This is true, but right now we're still in the fall, and since January, $7.4 billion in foreign purchases have been reversed. And that's because of falling confidence that China is actually going to be able to prevent a real crisis here. Even Michael Burry sold his Alibaba stock, which he was shilling for a long period of time. So, where do we stand now? Well, we actually stand at a real problematic crossroads. Because not only do you have a lack of savings, massive amount of debt, especially local debt, and high youth unemployment. In some counts, over 25%, maybe closer to 20% if you believe the official numbers, but now even those official numbers are being yoinked. That is, China won't be providing them anymore, amplifying the distrust in the CCP that individuals already have. But the government is stuck between a rock and a hard place in China. Why? Because get this, the more China starts stimulating, and China prefers corporate stimulus, you end up getting more power amongst those corporations. Consumers aren't getting the stimulus. Maybe that would be a good idea, but they're not. And so far, China is really just talking about lowering rates, which they just announced, and maybe some more top-line stimulus, trickle-down economic style. But China has a real fear that if you empower the corporations like Jack Ma and Ant, they will end up vocalizing their discontent with the government, become so powerful that they could potentially overthrow the government. So the CCP has to walk this fine line between stimulating but not overstimulating, because then they might lose power. But this is where you end up walking an even more dangerous line. And this is where the problem of deflation sets in. Ready for this? Once you are in a cycle of deflation, people distrust the government so much that even when you receive stimulus, you don't end up spending it. This is when you get to the failure of monetary policy. This is what happened in Hungary and Turkey, where you have the monetary side printing money, but nobody's spending it. So you're actually staying in recession or in deflation while you're printing money and increasing your debt burden. That is how currencies fail. That is how governments fail. That is how you create a deflationary spiral. Why is the deflationary spiral bad? Think about it. Companies stop hiring. When companies stop hiring, they stop being able to pay people. As they stop being able to pay people, people get laid off. People who are laid off can't spend money. People who don't spend money lead businesses to have to lay off more people and spend less money. And this leads to ultimately less innovation, lower GDP for the long term, and potentially a lost decade, much like Japan had, where you essentially have this extended recession/depression, and you actually can't print your way out of it. Japan has been having this issue. They've been printing money hoping to get out of this problem, but they're not able to get out of the problem. This is why Citigroup is now arguing that China is on track to basically Japanify. Okay, maybe that's not the perfect word to use, but China's future growth prospects may be decelerating more sharply, with growth-enhancing structural reforms looking elusive. We argue that China is on track for Japanification based on policy responses delivered so far. Now, China does have more room to grow than Japan did in the 90s, but its productivity growth may be slowing more sharply, undermined by the dominance of the state. That's the power of the state above and beyond the corporation. Geopolitical headwinds, drags associated with middle-income economies, basically people being fearful to spend, and China's demographic profile now deteriorating faster than Japan's did, with a much lower level of per capita income. In other words, a slowing population growth, if anything, a declining population in number, an aging population, and those things happening worse than when it happened in Japan post their bubble. All of this has led to some pretty crazy pieces. Take a look at this one. Foreign affairs. The end of China's economic miracle. How Beijing's struggles could become an opportunity for the West. Now, I've highlighted some things in here that I'd like to point out. the decline of China's durable goods consumption and private sector investment rates to a fraction of their earliest levels, and by the country's surging household savings rate, reflect the long-term loss of faith that people and companies have in the Chinese government and the country. This unfortunately creates very deep problems. It's worth noting that currently the savings rate, household savings rate as a percentage of GDP, has risen to 50%. It's 17% in America. Now, for a moment, you might be thinking, oh, well, people are saving more money. That means they have more money to spend, right? Maybe, but they're fearful to spend. That's the structural problem. Some are now calling this an economic case of long COVID, like economic long COVID. And that's because fear is coming in. Now, it's of course reasonable to be fearful. I mean, they say here, in the face of uncertainty and fear, households and small businesses prefer cash savings to illiquid investments. As a result, growth persistently declines. Now, what kind of cash? Well, actually, the most desirable would actually probably be the dollar for China. Now, there are capital restrictions. You could only save about 50,000 USD, but given that the per capita income in China is less than 50,000 USD per year, and you're not going to save every dime, this probably isn't a big deal for 99.9% of Chinese. It's probably a bigger deal for people who are wealthier. But for the average Chinese, it's probably not such a big deal, and you could practically save money in US dollars or potentially crypto, but crypto is going to be obviously a bit more volatile, so potentially less likely of a choice for Chinese in the environment that we're in today. Instead, people sit on the cash that they can get their hands on. In the past, citizens used to believe, hey, look, as long as I don't get into politics, no problem. But unfortunately, following what happened with Jack Ma, people are fearful that everyone is at risk. And remember what happened during COVID? During COVID, somebody ended up with COVID in your area. Guess what? You had robots start flying around, robotic drones shouting with megaphones to lock everything down and stay home. And then you're arbitrarily left without income, stimulus, or customers for your business for months at a time, thanks to the way the Communist Party handled lockdowns. So, of course, you're going to have some fear when your government can pull this off. But on top of that, people's lack of spending is driven by the belief that people are at the mercy of the government's whims, of a real estate bubble, and fears of overregulation. Fortunately, we still have a lot more freedom in America, though people are beginning to doubt that as well. Now, it's also worth noting that policies can be enforced arbitrarily. That is, it's not even equal application of the law for everyone in China. A lot can be driven by the party's will, which actually sounds very familiar to some of the problems we have in America, where a government party or an autocratic regime chooses to enforce laws against certain people and not others. But once you lose that confidence in average people, really difficult to win that back. That's unfortunate for China because it's happening not just in one part of one party, but it's happening across the board. This could lead to a decades-long drag on productivity and economic growth in China. And when another global recession hits, unfortunately, China isn't going to be able to help. Now, Foreign Affairs believes that the best thing the United States could do is actually trying to accommodate China by being less restrictive and getting some more investment going into China and encouraging, maybe intellectuals from China to come to America, easing immigration policies, and actually coordinating the economies more. That would actually play into Cathie Wood's argument that, hey, China can export lower inflation to the United States because we could take advantage of lower prices. But our government today seems steadfast on the idea of separating itself from China and putting more barriers between us and China. That was true during the Trump administration. It's true now with the Biden administration. Both administrations were very fight China, anti-China. This is not great. And of course, some things we should definitely harbor for ourselves, like our artificial intelligence, technologies, and some of our best military secrets and plans for the best weaponry and planes and otherwise. Of course, that is one way that we can maintain some of our national defense to the extent that we have national defense. But what does this really mean in terms of what's next? Well, some say this could all be a blip, that China will recover soon enough. Others say no, China's actually going to have to go through a massive debt restructuring, a big reset. And only through a big reset can you actually end up regaining people's trust. Maybe you even need new politicians in China, though that's probably only going to come through serious revolt. And that's actually dangerous because it makes nuclear war a possibility. The more China's economy falters, the more dangerous the CCP becomes as it tries to grasp on power. And especially as they relate more to Russia as a way to balance out the West, there is a greater risk of nuclear war with China the worse their economy gets. Ray Dalio says in his book, Principles, that there are a few ways to have a debt restructuring. You could go through austerity, which Europe went through post-2010. You could ask people to basically cut what they're expecting to get back from the government, take a haircut on their loans. You could redistribute wealth to the extent that they already haven't done so. You could print money, but that doesn't work if you have an already weak currency and people are in a deflationary mindset. Or you can boost productivity, which is probably the best thing to do, and it's what America does. America can boost productivity and boost its GDP and escape some of the deep debt problems that we have. Hopefully, knock on wood, that's the goal. China seems like a less convincing story for real productive gains. That is actually scary because it does mean that China could be a sandbag for global GDP much longer. But in addition to war, what else is an issue? Well, earnings. Consider that 25% of NVIDIA, AMD revenues come from China. Consider a large percentage of production that's completed by Tesla in China, around 45%. Now, they use China as an export market, so maybe that's a way to take advantage of some disinflation. But Starbucks, Apple, Nike, Under Armour, Coke, and many more companies rely on revenues from China. A decline in sales here could offset the strength that the American consumer is showcasing, leading even America into a recession. This is, of course, leading a lot of folks to avoid investments in China and sell off investments in China in the short term, but eventually that'll lead to buy the dipping in China, which is also a drag on the US stock market. So, what else do we consider? Well, consider that there's a velocity of money globally that occurs. When India and China trade less, India has less money to invest in American companies trying to invest in India. The same is true for other countries around the world. China is a big anchor to the global economy. So, a great reset in China is going to be painful for the entire world. It could end up being an opportunity for the United States if our economy grows enough, but we're going to have to grow so strongly and so rapidly that we actually offset their anchor. That is going to force the Federal Reserve to cut interest rates sooner than they're currently leading on. In other words, more pain in China, more likely rate cuts sooner. But in the meantime, be careful making bets on China because we just don't know where the bottom is yet. Thank you so much for watching. Check out the programs on Building Your Wealth, linked down below, with buy and sell alerts in the Stocks and Psych course, real estate analysis in the real estate course, and education on how to make more money, increase your top line, featuring artificial intelligence in every aspect of your business and career. Check those out, linked down below. Thank you so much for watching. Goodbye. Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by artificial intelligence. If you can master AI by starting on the ground floor, let's go.